Welcome to This Explainer. Every single day we're bombarded with headlines screaming about chaos in the Middle East and international conflicts. But what if I told you the engine of the global economy is actually sputtering in Tokyo? Today, we're skipping the sensational distractions and looking straight at the hard numbers to uncover an invisible crash that's quietly unfolding literally right now.
The media really wants you glued to the Strait of Hormuz and the rising price of oil. It's a classic distraction because the real threat to your 401k, your savings account, and even your mortgage, it's hiding right behind the bright neon signs of Japan. In 2024, after 17 years, the planet's biggest creditor abruptly ended its era of free money, and those shockwaves are heading straight for your wallet. But to really get why this matters, we have to start at the very foundation of Japanese society.
Section 1. The Demographic Black Hole. Japan's Dark Secret.
Okay, to grasp this impending crash, we first have to look at Japan's demographic death spiral. On the surface, Japan looks like the ultimate future, right? Smart cities, massive tech giants, AI. But the data tells a terrifying story. As of 2026, Japan's population has shrunk down to 122.6 million. Now, that might sound like a lot, but back in 2010, they had 128 million. They are bleeding about 500,000 people every single year. Just to put that into perspective, that is the equivalent of the entire city of Atlanta just vanishing every 12 months.
And it's not just that there are fewer people. The population is aging incredibly fast. By 2022, over 29% of Japan's population was over the age of 65. Their birth rate has hit a century low. We're at this catastrophic tipping point where there are literally 2 deaths in Japan for every single birth. And every year this goes on, the tax base just crumbles a little bit more. With fewer families paying taxes, the country's financial foundation cracked, and that forced their central bank into a desperately risky gamble.
Which brings us to Section 2, the infinite money glitch. The free money era. So, to fight this disappearing tax base, the Bank of Japan did something totally unprecedented. Instead of raising interest rates, they made money completely, 100% free. They slashed rates to zero, and sometimes they even pushed them below zero. They pumped trillions of yen into the system and basically socialized their own stock market just to keep the country's lights on. It was this massive gamble to make borrowing irresistible. And sure, it acted like a band-aid for a bit, but it opened the door for something absolutely massive on the global stage.
While I was looking into this, I realized that Wall Street hedge funds essentially found a real-world video game infinite money glitch. They realized they could borrow absolutely huge amounts of this free Japanese cash at a 0% interest rate. Wall Street called this the yen carry trade. For a long time, it seemed like a totally foolproof way to guarantee massive returns, all built on the comfortable assumption that Japan would simply never raise their rates.
Here's exactly how they did it. Wall Street executed 3 very simple steps. Step 1, borrow yen for basically nothing. Step 2, convert that cash into US dollars. And step 3, use those dollars to buy high-yielding US tech stocks and Treasury bonds. For years, this brilliant little system used Japan's stagnant economy to quietly grease the wheels of the entire global financial machine, constantly pumping up American markets.
But then we hit Section 3. The Widowmaker detonates. The glitch gets patched.
Because anyone who plays games knows, eventually glitches get patched. This 17-year gamble by the Bank of Japan was a ticking time bomb. For years, there was this famous strategy on Wall Street built on shorting Japanese government bonds. Betting prices would eventually fall and yields would rise. But betting against the Bank of Japan usually meant losing your shirt. It was so dangerous it earned the terrifying nickname, the Widowmaker. Investors lost billions because Japan stubbornly held rates at zero. Well, that is, until 2026, when global crude oil prices suddenly surged by nearly 50%.
Now, for a resource-poor country like Japan, rising energy costs are basically a death sentence. While the US and Europe were hiking their rates to fight off inflation, Japan was totally trapped. If they raised rates, they'd bankrupt their own government, which carries a staggering 260% debt to GDP ratio, so they kept rates at 0%. The result? The yen went into an absolute freefall. It went from 110 to the dollar back in 2021 all the way to near 160 by April 2026. The currency lost 30% of its value, absolutely devastating the savings of the Japanese public.
To save their rapidly crashing currency, policymakers panicked. They made a decision almost 2 decades in the making. They officially ended 17 years of free debt. They raised rates to 0.75%, targeting 1% by 2027. I know that sounds tiny compared to US rates, but for Japan, that is an absolute earthquake. The Widowmaker bet finally paid off for the shorts, and the infinite money glitch was officially patched.
Moving into Section 4, the Great Repatriation, the money returns.
This right here is the invisible crash happening right under our noses, the massive repatriation of the yen. Trillions of dollars, borrowed at 0%, are seeping out of global markets and heading straight back home. And here is why that absolutely matters directly to you. Japan is the biggest foreign holder of American debt. As a nation, they own a staggering $1.2 trillion in U.S. Treasuries. To put that insane number in perspective, that is enough money to fully fund the entire U.S. military for 18 months, held by one single nation.
And it's super fascinating to look at who specifically holds that debt. The Japanese Government Pension Investment Fund, the world's biggest pension fund, historically dumped a massive 51% of its entire foreign bond portfolio directly into America's debt. Why? Well, U.S. bonds paid out interest, and Japanese ones paid literally nothing. But guys, that logic is officially dead.
Because with Japanese interest rates rising, Japanese 10-year domestic bond yields have surged past 2%. The math has completely flipped. There is zero incentive for Japan's megabanks and pension funds to run the risk of holding American debt abroad when they can just safely invest in their own government bonds right at home. The exodus has already begun. Japan is cashing out and dumping U.S. Treasuries at a record rate.
So, think about it. What happens when the biggest buyer of U.S. debt just bows out? Well, the Federal Reserve has to step in and raise rates to attract new buyers to absorb that $1.2 trillion. And when the Fed raises rates, literally everything in your life gets more expensive. Mortgage rates climb, credit card interest rates absolutely soar, your everyday purchasing power shrinks as costs spiral out of control. And at the exact same time, the stock market starts to bleed. Remember those Wall Street hedge funds living off the 0% yen carry trade? They're now watching their borrowing costs absolutely explode. Backed into a corner, they are forced to cover their yen debts by panic selling their prized, most profitable positions. We're talking massive shares in companies like Apple, Nvidia, and Microsoft getting dumped just to cover these spiraling debts. This is the invisible crash, happening quietly while the world is completely distracted.
Finally, Section 5, the sovereign debt trap. No way out.
This invisible crash brings us to an unavoidable powder keg that the global economy has been building toward for nearly 2 decades. Japan is stuck in the ultimate sovereign debt trap. They are pinned between two incredibly dangerous outcomes. Option 1, they keep interest rates low to protect their massive government debt, but watch their currency collapse to nothing while their country starves from import inflation. Or Option 2, they raise rates to save their currency, but in doing so, they set their own national debt on fire and detonate the entire global bond market by pulling trillions out of the US and Europe. There is no magical third option here.
The fuse was lit a long time ago. The yen was really just the first domino to fall. The great repatriation of capital is fully underway, US tech stocks are taking the collateral damage, and the dollar is absolutely next in line. As the chalk dust settles on this 17-year economic experiment, we're staring down a chilling question that the world has been quietly avoiding. When the biggest buyer of American debt completely leaves the table, what happens if the U.S. economy crashes? Keep that in mind as you watch the markets this week. Thanks so much for joining me on this explainer, and remember to keep your eyes on the numbers.